Something extraordinary just happened in the gold market. And if you miss what I'm about to show you, you might look back in 5 years with serious regret. I'm talking about a technical signal that's only appeared 3 times in the last 50 years. And each time it showed up, gold went on an absolute tear. We're talking triple-digit percentage gains, the kind of moves that turn modest positions into life-changing wealth. But here's what makes this moment different. This isn't just about one indicator flashing green. We're seeing a convergence of factors that hasn't occurred since the early 1970s. And if you know your gold history, you know what happened next. Let me walk you through exactly what's happening right now, why the smart money is positioning aggressively, and what this means for anyone holding dollars or sitting in traditional retirement accounts. The signal I'm referring to is called a golden cross on the monthly chart. Now, I know technical analysis can sound like astrology to some people, but stay with me because this particular pattern has an almost eerie track record. A golden cross occurs when the 50-month moving average crosses above the 200-month moving average. Think of it as the market's long-term momentum shifting decisively upward. It's not a short-term trading signal. It's a structural shift that typically plays out over years, not months. The last time we saw this exact setup was in early 2003. Gold was trading around $350 an ounce. Most investors thought it was a relic, a barbarous relic as Keynes called it. The conventional wisdom said gold had no place in modern portfolios. But something was stirring beneath the surface. Central banks had been net sellers for years, and that was about to reverse. China was industrializing at breakneck speed. The dollar was beginning a long decline. And the Fed had just cut rates to 1% in response to the dot-com crash. What happened next? Gold went from $350 to over $1,900 by 2011. That's a 440% gain. If you had $50,000 in gold when that signal flashed, you were sitting on $270,000 8 years later. Before that, the signal appeared in 1979. Gold was around $250. Inflation was raging. The dollar was collapsing. Trust in government was at historic lows after Vietnam and Watergate. Paul Volcker hadn't yet stepped in to break inflation's back with 20% interest rates. Gold went from $250 to $850 in just over a year, a 240% move in 12 months. People who understood what was happening made fortunes. People who dismissed gold as a pet rock watched their purchasing power evaporate. And now, here we are again. The monthly golden cross just confirmed. But this time, the underlying fundamentals are even more compelling than they were in 2003 or 1979. Let me show you what I mean. Start with central bank buying. In 2022 and 2023, central banks purchased more gold than in any year since 1950. We're talking about 1,000 metric tons per year. That's not normal accumulation. That's panic buying. Who's buying? China, Russia, Turkey, India, Poland. Countries that are actively trying to reduce their dependence on the dollar. They're not buying gold because they think it's going to $2,700 or $2,800. They're buying because they see what's coming for the dollar-based system. China's been particularly aggressive. Official numbers show they've added about 300 tons to reserves over the past 2 years. But here's the thing. Those are just the official numbers. Most analysts believe China's actual holdings are far higher. They have every incentive to accumulate quietly and report slowly. Why does this matter? Because when central banks buy gold, they're not trading. They're not looking to flip it for a quick profit. They're making a strategic decision about the future of money. They're building a foundation for a post-dollar world. And it's not just emerging markets. Even Western central banks have stopped selling. Remember, from 1999 to 2009, European central banks were dumping gold under something called the Central Bank Gold Agreement. They sold thousands of tons. That selling pressure kept a lid on prices for years. That's completely reversed. Now they're holders. Some are even buyers. The selling pressure that suppressed gold for a decade is gone, and it's not coming back. Now layer in what's happening with supply. Gold production peaked in 2018 at about 3,300 tons per year. Since then, it's been flat to declining. The easy gold has been mined. New discoveries are rare. The ore grades at existing mines are falling. It now takes major producers 7 to 10 years to bring a new mine online. That's exploration, permitting, construction, everything. And with gold prices where they are, many projects still don't pencil out at current costs. Meanwhile, demand is surging, not just from central banks. Jewelry demand in India and China remains strong. Industrial uses are growing as gold finds applications in electronics and green technology, and investment demand is starting to wake up. That last point is crucial. Investment demand has been relatively muted compared to previous bull markets. Gold ETF holdings actually declined in 2023 even as prices rose. That tells you this move has been driven by physical buyers, not speculators. What happens when Western investors finally wake up and start piling into gold ETFs and mining stocks? That's when things get really interesting. That's when you see the kind of vertical moves that characterized 2010-2011. Let me paint a picture of what that looked like. In 2010, gold started the year around $1,100. By December, it was at $1,400, a 27% gain. Not bad. But then 2011 hit. Gold went from $1,400 in January to $1,900 by September, another 35% in 9 months. People who had been accumulating during the quiet years from 2003 to 2009 made life-changing money. People who waited until gold was making headlines paid top dollar, and many got shaken out in the correction that followed. The lesson? The time to position is when the signal flashes, not when your neighbor is talking about gold at dinner parties. Now, let's talk about what's different this time. Because while history rhymes, it never repeats exactly. The debt situation is far worse than it was in 2003 or even 1979. U.S. federal debt is now over $36 trillion. That's more than 120% of GDP. Interest payments on that debt are approaching $1 trillion per year. That's more than we spend on defense. Think about that. We're paying $1 trillion a year just to service existing debt. And that's with rates that are still historically low by 1980s standards. If rates went to where Volcker took them, the interest expense would consume the entire federal budget. There's no way out of this through growth. We'd need sustained 5 to 6% real GDP growth for decades to grow our way out. That's not happening. The demographics don't support it. Productivity gains aren't there. We're a mature economy with an aging population and massive entitlement obligations. So what are the options? Default, political suicide, austerity, also political suicide. That leaves one realistic path. Inflate the debt away. Print money, keep rates low, and let inflation erode the real value of what we owe. That's exactly what happened in the 1970s, and it's exactly what's starting to happen now. The Fed talks about 2% inflation targets, but actual inflation as experienced by real people is running much hotter. Housing, food, energy, healthcare, education, all up dramatically over the past few years. Gold is waking up to this reality. It's starting to price in a future where the dollar's purchasing power continues to erode, where the Fed is trapped between fighting inflation and keeping the government solvent, where the only way out is through currency debasement. Here's another factor that wasn't present in previous gold bull markets. The BRICS nations are actively working to create alternatives to the dollar system. They're building payment systems that bypass SWIFT. They're settling trade in local currencies. They're talking about a gold-backed trade currency. Now, I'm not saying the dollar is going to collapse tomorrow. The dollar is still the world's reserve currency. It's still the most liquid, most trusted currency for international trade. That doesn't change overnight. But the trend is clear. The dollar's share of global reserves has been declining steadily. It's now around 58%, down from over 70% in 2000. That might not sound dramatic, but in the world of reserve currencies, that's a massive shift. And every percentage point of decline means less demand for dollars and treasury bonds, which means the Fed has to work harder to find buyers for U.S. debt, which means higher rates or more money printing. Either way, it's bullish for gold. Let me tell you a story that illustrates what's happening. In 2018, Germany tried to repatriate its gold from the New York Fed. They'd stored hundreds of tons there since the Cold War. It took them 7 years to get it all back. 7 years. Why so long? Officially, it was about logistics and security, but many analysts believe it was because the gold wasn't sitting in a vault ready to ship. It was leased out, hypothecated, part of the fractional reserve gold banking system that operates in London and New York. This matters because it reveals something important about the gold market. There's physical gold, and there's paper gold. The paper gold market, futures contracts, ETFs, unallocated accounts, is many times larger than the physical market. Most of the time, this works fine. People trade paper claims to gold, and only a small percentage ever demand physical delivery. But what happens if confidence cracks? What happens if a significant number of paper gold holders suddenly want the real thing? You get a squeeze. The kind of squeeze we saw briefly in March 2020 when the futures market nearly broke. The kind of squeeze that could send gold prices vertical as the paper market scrambles to find physical metal to deliver. And here's the thing. The conditions for that kind of squeeze are building. Physical premiums in Asia are elevated. Delivery times for large bars are extending. Central banks are draining physical supply. The ratio of paper to physical gold is probably higher than it's ever been. One spark, one loss of confidence in the paper market, and we could see a repricing that makes previous bull markets look tame. Now, I want to take a quick detour here because this is important for anyone thinking about their retirement. If you're sitting on $100,000 or more in a traditional IRA or 401k, you need to understand something. That money is denominated in dollars. If the dollar loses purchasing power, your retirement loses purchasing power. It's that simple. A lot of people don't realize you can hold physical gold inside a retirement account. It's called a gold IRA. You can roll over funds from existing retirement accounts without triggering taxes or penalties. The gold is held by a custodian, fully IRS compliant. I put together a free guide that walks through exactly how this works, what the costs are, how to avoid the common mistakes. It's in the description below. If you're concerned about dollar debasement and want to protect your retirement purchasing power, it's worth checking out. All right, back to the market dynamics. Let's talk about what happens next, because a golden cross is just the beginning. It's the signal that the trend is shifted. But the real gains come in the years that follow as the new trend plays out. If this follows the pattern of 2003, we're looking at a multi-year bull market. Not a straight line up. There will be corrections, consolidations, periods where it feels like nothing is happening, but the overall trajectory should be higher. The first target most analysts are watching is the old all-time high around 2,075. We've already tested that level and broken through. The next psychological level is $2,500, then $3,000. But here's what most people miss. In inflation-adjusted terms, gold would need to hit $3,500 just to match its 1980 peak. If you adjust for the expansion of the money supply since then, the number is even higher. Some estimates put the inflation-adjusted equivalent of $850 in 1980 at over $15,000 today. Now, I'm not predicting gold goes to $15,000. That would require a complete loss of confidence in fiat currencies. But it illustrates how far gold could run if we see even a fraction of the monetary chaos that characterized the late 1970s. And the setup for that chaos is in place. We have record debt, political dysfunction, geopolitical tensions, a fragmenting world order, and central banks that have proven they'll print unlimited money rather than allow deflation. Think about what happened in 2020. The Fed expanded its balance sheet by $3 trillion in a matter of months. They bought everything, treasuries, mortgage bonds, even corporate debt. They backstopped the entire financial system with newly created money. That money didn't disappear. It's still sloshing around in the system. It's why asset prices are so elevated. It's why inflation took off in 2021 and 2022. And it's why gold is starting to wake up. Because gold isn't just a hedge against inflation. It's a hedge against monetary chaos. It's what you own when you don't trust the people running the printing presses. Let me give you another historical parallel. In 1971, Nixon closed the gold window. He ended the dollar's convertibility to gold. It was supposed to be temporary. It's now been over 50 years. What happened to gold after 1971? It went from $35 an ounce to $850 by 1980, a 24-fold increase. The dollar lost 95% of its value against gold in less than a decade. We're not in 1971, but we are in a moment where the monetary system is under stress, where the assumptions that have held for decades are being questioned, where countries are actively trying to reduce their dollar dependence. If even a fraction of global wealth shifts from dollars to gold, the price impact will be enormous. We're talking about a $100 trillion bond market, a $50 trillion stock market, and hundreds of trillions in global wealth. Gold's total market cap is around $15 trillion. If just 1% of global wealth shifts to gold, That's trillions of dollars of buying pressure hitting a market that produces less than $200 billion of new supply per year. The math is simple. Prices have to rise to balance supply and demand, and that's before you consider the leverage in the mining sector. When gold rises, mining companies don't just benefit from higher prices. Their profit margins expand dramatically because their costs are relatively fixed. A mining company that produces gold for $200 an ounce makes $800 per ounce when gold is at $2,000. If gold goes to $3,000, they're making $800 per ounce. Their profits more than double while gold itself only rises 50%. That's why gold mining stocks typically outperform gold itself in bull markets. In the 2003-2011 bull market, gold rose 440%. The gold mining index rose over 600%. The best individual miners rose 1,000% or more. We're seeing early signs of this dynamic starting to play out. Mining stocks have been outperforming gold over the past few months. Money is starting to flow into the sector. But we're still in the early innings. Most investors don't own any gold or gold stocks. Most financial advisors still recommend little to no gold allocation. The mainstream narrative is still that gold is a barbarous relic with no place in modern portfolios. That narrative is about to change. It always does when gold starts making new highs. Suddenly, the same analysts who dismissed gold at $1,500 will be recommending it at $2,500. The same advisors who said it was too risky will be adding it to model portfolios. By then, the easy money will have been made. The time to position is now, when the signal has just flashed, but before the crowd arrives. Let me address the common objections because I know what some of you are thinking. Gold doesn't pay dividends or interest. True. But it also doesn't have counterparty risk. It can't be printed. It can't be debased. It's held its value for thousands of years while every fiat currency in history has eventually failed. Gold is volatile. Also true. But volatility cuts both ways. Yes, gold can drop 20-30% in corrections. It can also rise 50-100% in a year when conditions are right. If you can't handle volatility, you probably shouldn't be investing in anything beyond treasury bonds. The government could confiscate gold like they did in 1933. Possible, but unlikely. The circumstances that led to the 1933 confiscation don't exist today. We're not on a gold standard. The government doesn't need your gold to back the currency, and the political backlash would be enormous. I missed the move, it's too late. This is the most dangerous objection because it keeps people on the sidelines. Gold has risen from $1,800 to $2,600. That's a nice move. But if this plays out like previous bull markets, we're maybe 20-30% into the total move. The majority of the gains are still ahead. Think about someone who bought gold in 2005 at $450. By 2008, it was at $900. They doubled their money. Some people thought they'd missed it, but gold went on to hit $1,900 by 2011. The people who bought at $900 still more than doubled their money. The point is, bull markets are long. They give you multiple opportunities to participate. The worst thing you can do is wait for a pullback that never comes, or that comes from much higher levels. Here's what I'd be watching going forward. First, central bank buying. If that continues at current levels or accelerates, it's extremely bullish. Central banks are the ultimate long-term holders. Their buying removes supply from the market permanently. Second, investment flows into gold ETFs. Right now, ETF holdings are below their 2020 peaks. When Western investors start piling in, that's when you see the parabolic moves. That's when gold goes from $2,600 to $3,500 in a matter of months. Third, the dollar. Gold and the dollar typically move inversely. A weakening dollar is rocket fuel for gold, and the dollar is facing serious headwinds. The trade deficit, the budget deficit, the loss of reserve currency status all point to a weaker dollar over time. Fourth, real interest rates. Gold tends to perform well when real rates are negative or low. Right now, with inflation running above treasury yields in many maturities, real rates are barely positive or negative. That's a supportive environment for gold. Fifth, geopolitical stress. Gold is the ultimate safe haven. When the world feels dangerous, people buy gold. And the world feels pretty dangerous right now. Tensions with China, the war in Ukraine, instability in the Middle East, political polarization at home, all of this supports gold. The confluence of these factors is what makes this moment special. It's not just one thing, it's everything lining up at once. The technical signal, the fundamentals, the macro environment, the geopolitical backdrop. It's all pointing in the same direction. I've been following gold markets for over 2 decades. I've seen bull markets and bear markets. I've seen false starts and real breakouts. And I can tell you, this feels different. This feels like the beginning of something significant. The Golden Cross is just the confirmation. The real story is what's happening beneath the surface. The structural shift away from dollar dominance. The recognition that we can't print our way to prosperity forever. The understanding that gold is money and everything else is credit. This isn't about getting rich quick. This is about preserving wealth in an environment where currencies are being debased. It's about having an anchor to reality when everything else is floating on a sea of debt and printed money. The people who understand this are positioning now. They're not waiting for confirmation from CNBC or their financial advisor. They're looking at the same data I'm showing you and drawing the obvious conclusions. Gold just flashed a buy signal that only appears once or twice in a generation. The last 2 times it appeared, gold went on multi-year bull runs that created enormous wealth for those who paid attention. This time, the fundamentals are even more compelling. The debt is higher. The monetary system is more fragile. The geopolitical tensions are more severe. And the central banks are buying more aggressively than ever. You can wait for more confirmation. You can wait for gold to hit $3,000 or $3,500. You can wait until everyone is talking about it. But by then, the easy money will be gone. By then, you'll be buying what the smart money is selling. Or you can recognize that moments like this are rare, that the convergence of technical signals and fundamental drivers doesn't happen often, that when it does, the prudent move is to act. The choice is yours, but don't say you weren't warned. Don't say you didn't see it coming, because the signal just flashed. And history is pretty clear about what happens next.